Welcome, everyone, and thank you for joining us here today. It looks like many of you have arrived safely. I know I've gotten some messages that people are having trouble signing in, so hopefully most of those can sort out their issues. Just want to remind everyone as well that the session is being recorded. If you do end up with technical difficulties, we will have this recording available very shortly. Thanks again for joining us here to start off the OIC's webinar series for 2020. I want to cautiously wish everyone a happy new year. I know that many of us are still dealing with stressful situations of various kinds, but I hope everyone is doing well and navigating the market successfully. My name is Edward Modla, the Principal of Investor Education at OCC, and I'm here today to give what's a basic level, mostly ground floor presentation on options, core concepts, and terms. First, our disclaimer: options are not suitable for everyone. They are a rather complex tool that needs to be studied and understood before using them in a live account. I will be walking through some examples today with profit and loss graphs and calculations. I want to emphasize those are for illustrative and educational purposes only and should not be construed as any kind of endorsement or advice. A little bit about OIC. We were founded in 1992 as an industry resource to provide free and unbiased education to all market participants. You can find us at optionseducation.org, where we have a lot of written educational material, online courses, and previously recorded podcast videos and webinars such as these. We also have dozens of prior presentations uploaded to our YouTube channel. You can simply go to YouTube and look up Options Industry Council and find us there. Also, the investor education team is available by email. You can find us at options@theocc.com. Ask us about the education we have to offer, or ask options-related questions. We're not licensed to talk about market direction or give you guidance on ticker symbols, but we'll try to help you out as best we can. Speaking of the investor education team, I have a couple of other OIC instructors online here with me today. Mark Benzaquin and Ken Keating will be answering your questions through the Q&A screen that you hopefully see on your screen. So if you want to send in questions, just fire away. Those two guys will be answering questions all throughout the presentation today, and Ken Keating will be joining me live on the air when I'm done with my presentation, so we can walk through and talk about a few of those questions and common topics that are coming through in the Q&A. I want to start with a quick snapshot of annual volume in the options industry, and certainly you can see how extraordinary last year was. Prior to that, 2018 and 19 were the record-setting years. They were kind of dwarfed. They don't look so impressive anymore when it comes to volume. You see there at the turn of the century, you had that increase in volume. There was electronic trading. There was speed and access to the markets. There was education that really drove explosive growth. 2018 and 19 had a bit of heightened volatility. But last year was just very unique in so many ways. Options were used for a variety of reasons. To protect portfolios in times of stress, options are often turned to. We also saw quite a bit of speculation in the markets as there was large price movements in both directions early in the year to the downside, and then through the summer and fall months through the end of the year to the upside. And there was a significant amount of option speculation driving all of that growth. You see the number on the left. That's over about 7.5 billion contracts traded last year. And we'll see what happens in 2021. If that type of activity continues, we will soon find out. The outline for today will start with a very basic level options defined. That'll be very ground floor. I'll spend most of my time today talking calls and puts and basic strategies, and then we'll finish it up with some of those core concepts, contract terms, exercise and assignment, particularly things such as moneyness and auto execution, exercise by exception, things you really do need to know and understand whether you're an option buyer or seller. First, let's just think about trading stock. Most of you are familiar with trading shares of stock, and when you do so, you are sending in an order to buy or sell shares. that order is received at the stock exchange level and potentially executed against the other side. Shares are traded on the stock exchanges. Options don't trade on stock exchanges at all. There are separate options exchanges where bids and offers and orders are going to in an effort to buy or sell options contracts. They are not trading shares at all. Options instead are contracts that give the buyer rights and the seller taking on obligation. The buyer pays money up front and in exchange for that payment receives the right to exercise some kind of transaction in shares of stock. It could be buying, it could be selling, and all the details there within are going to be defined within the contract. The buyer pays for rights. The seller of the option contract is paid cash upfront, non-refundable, and in exchange for that payment is willingly accepting the obligation to execute a transaction in shares of stock, the opposite transaction that the buyer has rights to. Those details of what price might this transaction take place at, what share price, and how long do these rights and obligations exist are defined within the contract. And of course, those details go a long way in determining what the price of this option is going to be. There are many choices that investors have. Do they want to buy or sell the underlying asset? What particular price? What expiration date? You can choose whatever you're most comfortable with, and that choice is going to drive price. Speaking of price at a very basic level, ultimately all market participants, you, me, and everybody else that is sending a bid and an offer into the marketplace are the ones that are driving what that option price will be. There are pricing models that exist to help put some structure over what an investor or a trading firm believes an option should be trading for, but ultimately it comes down to simple supply and demand. I'll also point out that there is a very mathematical relationship between the different types of options that exist and often with in conjunction with the share price. And this mathematical relationship keeps prices in line. When one particular option's price changes, it affects other options around it, and it prevents the kind of anomaly prices that might exist, which would yield an arbitrage opportunity. There's a really tight relationship there that keeps prices fair and in line with each other. So a lot of different reasons why investors use options contracts. Here are some of them. At the forefront is risk reduction. This is somewhat similar to buying insurance. We'll look at an example of that in a little bit. And individuals are buying insurance on their home, on their life, on their car, but sometimes not buying insurance on their financial future. And that's what options can provide, the opportunity to reduce risk and buy protection on a stock or portfolio. Income generation generally refers to selling options. There's a number of reasons why an investor would want to do this: bringing cash into the account and improving the risk profile of whatever position they have. Stock acquisition is a very specific strategy. We'll also look at this one today, involving selling options and taking on the obligation to buy shares. So it's a method of acquiring shares through the options market. And then also speculation. I mentioned this happening a lot in 2020, perhaps more speculation than any year I have seen in the 23 years that I've been in the business, speculating on a directional move. You can sell options and speculate, but most often speculation is understood to be those larger moves up or down that involve buying options, spending a little bit of capital to control a larger amount of shares and capitalizing on a move in one direction or the other. A lot of these motivations work together as well. You can be selling options as a way to reduce risk, selling options as a way to acquire stock. Those speculation as well. You can speculate on a move by selling options and generating some income. So those motivations can work together all told, options are a very flexible product that allows investors to tailor their positions and tailor their portfolio to more closely reflect what their market outlook is in a way that you could not do if you were not using the options product. If you were just trading stock, it's very simple. There's not a whole lot you can do in a world with stock. It's straightforward. You're buying shares, hoping for a move higher and managing the downside, or you are shorting stock. Many investors are not shorting stock, but that's the other choice of yours in a bear market, to short stock and try and capitalize on a downward move, managing that upside risk. There's what you have when you're a stock trader. If you open the doors to the options world, a whole lot becomes available to you. And these are some of the available choices. Without paying too much attention to the names of each of these strategies, just focus on the fact that some of them profit as the market moves higher, others profit as the market moves lower. You'll see other strategies here that profit in either direction, some when the market consolidates. There's also different levels of risk. Some are uncalculated risk, some are measured risk. And this comes from being able to put options together in ways that construct these risk profiles to again, closely resemble what you want to accomplish in your portfolio. The ability to have this in your toolbox can greatly enhance your chances of being successful, but it takes time and dedication and some education on the options product before you can get to the point to utilize these strategies. It was just the other day an investor had asked me that they had seen a video online and someone was recommending buying the 15 call options in this particular stock, and they wanted to do the trade, but they didn't understand it. And you're seeing a lot of this today with recommendations and individual investors putting videos out on things that they are suggesting to do. And certainly, I'm not saying it can't be profitable to just listen and execute those same trades, but it's always prudent to understand what you're doing. It prevents errors. It allows you to recognize when something doesn't appear the way it should, perhaps in your account or your account statement. And without understanding exactly what it is that you're doing, it doesn't give you a good chance at long-term success to manage your own money. And that is ultimately when things can open up for you. So education is the key, and that's exactly what we do here at OIC. Let's look at the two types of options that exist, calls and puts. You can buy or sell either one of these. So there are 4 sides that you could potentially do at its most foundational level. You can buy or sell a call, or you can buy or sell a put option. There are rights and obligations attached to which one you bought or sold, and which side you have, whether you traded calls or puts, or whether you bought it or sold it. And that obligation is to execute a transaction in shares of stock. For a standard option, that transaction involves 100 shares of underlying stock or 100 shares of an ETF. Well, let's break out those 4 sides, calls and puts from either the buy side or the sell side. For equity call options, this call buyer has paid money up front, non-refundable, and now owns the right to buy the underlying stock at a particular price, and they own that right for a certain length of time. This investor is bullish on the underlying if they own the right to buy shares at a certain price and the share price moves higher, then the option they own would hopefully increase in value. You could certainly say that the share price moving higher is having a positive influence on the option that this buyer owns. This investor needs the stock movement to be in their direction, in their favor, to a greater extent that this investor is going to lose in the time decay of an option. Options are sometimes referred to as a wasting asset. With each passing day, there is some amount of its value that is going to be wasted as it approaches expiration. There's one less day for the stock to move and this option to gain value. Therefore, a certain amount of its premium is going to decay. The call buyer knows this and realizes they're going to suffer from decay as the expiration approaches, but based on their market opinion and analysis, they are confident that the stock movement, in this case higher, is going to overcome and have a greater positive influence on their option than they will suffer from time decay. An equity call seller has been paid cash upfront, non-refundable, and in exchange for that payment, they have taken on the obligation to sell stock or ETF. They are under that obligation up until the expiration date, and if called upon to do so, they will be selling shares at the strike price of the option. If this investor did not own shares, then the risk profile of this trade would look very similar to shorting stock, meaning to the upside, there's no protection. This investor would be at risk of losing more and more money as the stock trades higher. If they're obligated to sell shares at a certain price and the open market price keeps going higher and higher, they will continue to suffer losses. But unlike the short seller, the call seller can only profit the premium received. Shorting shares means you continue to profit as the stock drops and moves lower. The call seller can only profit off the premium they received up front. Therefore, most often it is likely to see that call sellers already have shares in their account. They are somewhat bullish on those shares moving higher, but they're looking for an alternative to using a limit order to sell shares. That's where selling calls comes in, selecting a strike price, selecting an expiration date, where the investor is comfortable selling their shares and then selling the option to bring in some premium, that's income generation, while they wait for the stock to drift higher. And if they end up selling their shares, they are comfortable with it. That's known as the covered call trade. Both of these strategies we're going to look at now on a risk profile with an example. Here we have the stock, going back to the call buying example here, buying the 140 strike call option for an option price of $3.60. I'll say this a few times today. Options are quoted on a per share basis. And what that means is when you see a price of $3.60, that actually means the total dollar amount is $360. That is what is paid for the option contract. Now, this P&L graph, as well as the others we'll see today, are drawn with the assumption that we have already reached expiration date. You certainly could sell your option for a profit or a loss based on changes in market conditions prior to expiration, but at expiration, we know exactly what the option would be worth given a stock price. Prior to expiration, that's not the case, because supply and demand and market forces are difficult to predict precisely. But at expiration, we know that if the stock is at 140, the option we purchased doesn't have any inherent value. We have the right to buy shares at 140. That's where the stock is. There's no real value there, so the option in that case would expire worthless, and you can see that would translate into a $360 loss. If the stock rallied, we need to pay ourselves back. What we spent on the option is $360. We need to get that back, and we will retrieve that premium if the stock rallies $3.60 above the strike price. That puts the break-even point at 143.60. Above that level, we start to profit. Stock goes to 145, 150, 155. Then we start to gain more and more profit. The downside here is that break-even. It's the fact that this option will decay. If you buy stock, there is no expiration date. You don't have decay, and you've got your break-even point at 140. Investors choose the option sometimes because of that low capital requirement. You are controlling 100 shares of stock, and you spent $360 to do so. That is opposed to buying 100 shares of a $140 stock, for example, that would cost $14,000. The option costs a lot less, You spend a lot less, that's leverage, that's speculating, and in order to get those advantages, you have to deal with time decay and a higher break-even point. This strategy is not easy to make money buying options directionally this way. If you do hit the analysis correct on the market direction, the magnitude, and the timing, then you have a chance to experience some really good returns in percentage terms. But it is hard to make money if you can't nail all three of those pieces, the direction, the magnitude, and the timing. And that's what makes this a strategy to pick and choose when's the right time to speculate buying calls. Selling calls, and this is assuming you own shares and you're doing covered calls, involves owning 100 shares of stock at some level, and instead of using a limit order to say sell your shares at 80, in this case you are selling an option with a strike price of 80, and you receive $180, that's $1.80 per contract times 100, $180 in order to take on that obligation. This lowers your entire cost of the trade. Instead of being out of pocket $75, you are now out of pocket $73.20. That lowers your break-even point. When you lower break-even points, that improves the probability of being successful on a trade. That's a tremendous benefit to using this strategy. What you give up in exchange for that is the far upside potential. As you can see, the long stock dashed line up above 80 as you continue to move into the mid to high 80s, continues to profit. Remember with the option, what comes along with receiving that premium? It's the obligation to sell stock at the strike price. We are obligated to sell these shares at $80. If the stock continues to rally above that level, we cannot capitalize on that further movement while this trade is in place. There are position management techniques that you can look into and consider that involve closing the option and trying to capture more on the stock movement. You can also change which option you've sold. You can buy back the 80 calls and sell something else. There are different things you can do when you get a little bit further into the details of this strategy, but in its most classic form, it has these two pieces. Selling the option gives you the benefit of lowering your cost, lowering your total risk, improving your break-even point, and still being allowed to capitalize on an upside move for those benefits you give up the far upside potential. Let's look at equity put options now. The definition of put options from the buyer's and seller's perspective starts the same way as calls. An equity put buyer pays money up front, non-refundable, out of their account, and they have purchased an option that gives them the right to execute a transaction in stock. That's all the same as calls. But in the case of puts, the right that this investor has purchased is to sell underlying stock or ETF. There are two common motivations for buying puts. One is to speculate instead of, in case of calls, speculating on an upside move. Buying puts would be speculating on a downside or bearish move in the underlying shares. As you own the right to sell stock at a certain fixed price, that right will gain value as the stock price goes further and further below that level. And that's speculating, trying to profit on move downward in the share price. If the shares are already owned, then buying a put option is the classic way to buy insurance on your position. There are different ways you can use options to buy protection, but buying an outright put option is the straightforward classic form of buying insurance. This is risk reduction. Just like insurance, you are paying a premium for this protection, and you now own the right to sell shares of stock at a particular price. That's the strike price of the option contract. It doesn't matter how far the stock drifts lower or sells off, you own the right to sell shares at the strike price that you have chosen, and you've paid for that right. Now, the difference between today's share price and the strike price of the option, if you think about that, where today's level is, how far down before the option itself gives you a right to sell shares. That difference you can think of as a deductible. How much do you give up before the protection kicks in? You choose your deductible, you choose your expiration date, and based on those choices, there will be a varying cost for the protection. Just like choosing your own insurance policy, the more expensive policies give better protection. Same thing here. You can spend a lot and get a lot of protection, or spend a little and get more or less catastrophic protection. An equity put seller is paid cash up front, non-refundable, into their cash account, and has taken on the obligation to execute a transaction in shares of stock. In the case of puts, that obligation is to buy shares of stock at the strike price of the option, and they are under that obligation until the expiration date of the contract. This is selling options and generating income, commonly waiting or believing that the share price will dip and that the current level is a bit too elevated for your comfort level. So if the share price drops and you get some pullback, you have an opportunity here to buy shares at a lower level, the strike price of the option, and you're getting paid effectively to work that limit order. What works here for the put seller is if the stock does not drift lower, if it consolidates or rallies, which means you're wrong, it did not pull back, you have the consolation prize of having a small profit in the amount of the option premium that you received up front. And that is one of the strong motivations to sell puts. You could be wrong that the stock does not drift lower and still have some level of profit to show for it. We're going to walk through both of these examples the way we did with calls on the risk diagram, with a hypothetical example for speculating with puts. We have the 200 strike put. This stock might be trading at 210 or 215. You think it's going lower. You're bearish. If you're a stock trader, there's not a whole lot you can do behind selling short the stock. That's something you might not want to do. So in this case, buying puts is a possibility. Paying $4 or $400 for the 200 strike put. This gives the investor the right to sell shares at 200. If the stock goes below that level and continues to go below that level, the option would hopefully gain in value. It certainly would have a positive influence. Always remember, when you buy an option and you own an option, you do have to deal with time decay along the way. The idea here is that the stock is moving lower, and you can see at expiration, in order to break even, we have to pay ourselves back the $4 that we spent up front. That means we need to have $4 of inherent value. If we have the right to sell shares at 200, we need that stock down at 196 to give ourselves back the $4 we paid up front, and there is our break-even point. If you are buying protection on a portfolio, looks, of course, a little different. Long stock at 120 in this example, and you are going to choose what strike price, what expiration date. It's entirely up to you based on your level of concern in the market. So I have identified here using a calculator. I used an option that expires about 6 months from now with 25% volatility and went 20% out of the money. And those are the details used to choose this level of protection for this position. Long stock at 20, buying the 100 strike for $2. So now, in addition to paying $120 for the stock, you have also paid $2 for the insurance. That means your total cost is $122, and that becomes your break-even point. You are increasing your break-even point here. That works against you. You need to pay yourself back for the option that you purchased. Your maximum loss now is controlled. You can only lose the deductible plus the premium. The deductible is the current stock level, 120, down to the strike price of the option. We will give up that $20 before we have the right to get out of this position and sell shares at 100. That's $20 we would then lose. The $2 cost up front is an initial sunk cost, so that leaves maximum loss at $2,200. Put options can be considered expensive, and as I said, there are other strategies you can use to protect the downside. You can use put spreads. I've heard some investors put together put butterflies, different things you can do down there, but in its simplest form to buy protection, the long put accomplishes just that. Selling puts, the cash secured put here is intended to potentially buy stock with the shares currently at 146. This investor is not comfortable buying the stock there at 146, so instead they sell a 140 strike put option at $2 or 200 total dollars. And again, identifying what details were used in the calculator to get that $2 premium, 30 days, about 25% volatility. And looking at the P&L graph, you see the current share price and what it means now to sell the options contract. If the stock stays above 140, then we will likely not be obligated to purchase shares. The put holder would not be interested in selling shares at 140 when the stock's trading above that level. But with the stock staying up above there until expiration, we would then simply see the option expire worthless and keep our max profit at $2. Break-even point would be if we were obligated to buy the shares and we've got a couple dollars of, say, a buffer zone to the downside. If we were obligated to buy shares at 140, then we're paying 140 for stock. We were paid $2 up front to take on that obligation. That leaves us with a break-even point of 138. If our market opinion was that the stock was going to drift lower into the high 130s, then this strategy would be consistent with that. You can see that it's similar to working a limit order to buy stock on a pullback, but getting paid to do so. It doesn't operate exactly like a limit order. The key difference is that when the stock trades at 140 or if it trades down to 139, a limit order will get filled. An options contract will likely not be assigned until expiration. So if that pullback in the share price happens and then there's a bounce up above 140 and all of that occurs before expiration, you might never get the shares. So again, with this position and other strategies, there's ways to manage through that. If you're concerned that that's the case, the stock's sitting there at 139, you've still got another week to go until expiration, you can then maybe decide to take action and close the option position and go ahead and buy shares of stock. There's different things you can do to manage the position, but as it's constructed, you would likely not get assigned until expiration. Let's summarize all of that and take a bit of a breather from all that explanation and just look at calls and puts. And I first want to maybe define long and short. There's a few different definitions that we use here in the options industry. When you hear long and short, you're likely thinking of market direction, long being bullish and short being bearish. That's the most common use of those terms. But here in the options world, in addition to using long and short to be consistent with that definition, long is also used to simply mean that you have purchased a contract. Other words used instead of long are the buyer of the contract or the holder. You're long the contract. It has nothing to do with market direction. And short, meaning you have sold this contract. You're the seller or you're the writer. Nothing to do with market direction, just that you sold the option contract. And putting this graph together, the call buyer or the call holder has purchased the right to buy 100 shares of stock at the strike price at any time up until expiration. Put buyers have paid for the right to sell shares of stock at the strike price at any time before expiration. Option buyers, looking across this row, option buyers pay for rights. And on the sell side, call sellers are receiving premium. They're paid up front and have taken on the obligation to sell stock, while put writers have taken on the obligation to buy shares of stock that they certainly might have an interest in doing. The entire universe of option strategies, I had that slide up in the beginning with a few dozen different strategies. The entire universe of strategies comes from these four pieces. This is the foundation of your knowledge. These four sides can be combined in different ways. You can put 2 of them together, 3 of them together, 4 of them together. You can change strike prices, expiration dates, quantities. You can include a stock position or not include it. Every single strategy that exists comes from, in one way or another, these 4 sides. And in addition to all the commonly known and defined strategies that exist in the options space, you can come up with your own positions that don't have any name at all. Just tailor the position to be exactly the way you want it to be. Now, the rest of what I go through today might be a little bit repetitive, but that's a good thing. That's by design. When you learn options, repetition is going to be helpful. So let's walk through some of the things I talked about before and outline them just in a different way. First, the contract terms. Equity option contracts have standardized terms. There is a such thing as options contracts that are non-standard. That likely is the result of some kind of a corporate action that has taken place while those options exist that has changed what those shares represent. Maybe a merger or a spinoff or a buyout. Those types of actions could cause options to change and be non-standard, but you may or may not come across that. If you do, hopefully your brokerage firm has a way of highlighting those contracts in such a way that you can easily pick those out. But a standard contract is going to identify certainly the stock that you have the right or obligation to trade, the unit of trade representing how many shares are we dealing with, the expiration date of the contract, and the strike price. When it comes to those non-standard contracts, it's usually the unit of trade and the strike price that might get affected. And again, hopefully your brokerage firm will have those stand out if you come across them. My word of caution is if you ever are browsing through your options chain of prices and something looks too good to be true, it probably is. The market is very efficient. It does not give away money for free. So if you're seeing a price that doesn't seem to make sense, it might be worth a little more investigating, because some of those non-standard options that, again, likely result from a corporate action might look like they have prices that don't make sense. But once you find out the details, you would then find out why. And when you look on your platform, you will see an option identified in a whole host of different potential ways. So we're just going to write it out here and showcase what details you will find in one fashion or another. First of all, what stock are we dealing with? Typically, again, for a standard contract, it's 100 shares of stock, and that becomes the underlying for this option. What stock are we potentially going to buy or sell based on our rights and obligations? The expiration date is certainly going to be identified, perhaps not this way, but we've written out January 21st, 2022 as the expiration date of the contract. For equity and ETF options, this is also the last trading date. You can open and close positions on the expiration date, but once you get to the closing bell, that's it. You cannot trade after the closing bell, and that's when exercise and assignment activity will take place. That's our last segment for today to talk about that process. Strike price will be identified, in this case 45 strike, the price at which the underlying may be bought or sold. Also attached to that will be whether or not this is a call or a put. Oftentimes you just see the letter C or the letter P to identify which option it is. Here we've written out that this is a call option. And somewhere, perhaps separately, you will see the option premium, the bid, the ask, the last trade, different columns for where you will find the option premium. Here, $2.50 for a standard option of 100 contracts. That means $250 total dollars as the option is quoted on a per share basis. To read through this from the buyer and seller's perspective, first the buyers. Let's just think about what we're doing here. Back to the top, the buyer of this options contract is paying $250 up front, and in exchange for that payment, they receive the right to buy 100 shares of stock ticker XYZ at $45, and they own that right every day between today and January 21st, 2022. If the stock drops below 45 and keeps going below 45, the value of this option would likely decrease, and it very well may expire worthless if it stays there. If the stock rallies up above 45, gets to 50, 55, 60, this investor is going to watch that trade and watch the premium and very well might decide to close the contract. If they had initiated this position executing a buy to open, they may turn around and sell to close this contract at $4, $5, $6, whatever they can get to profit. Exercising early is likely not going to take place in the absence of dividends. Dividends may change that discussion, but in the absence of dividends, there is likely not motivation for this option holder to exercise early. They want to get out of the position because they're done with it. There's a better chance that they might just sell and capture the premium. Now, from the seller's perspective, the seller of this contract has been paid $250 up front, and in exchange for that payment, they have taken on the obligation to sell 100 shares of stock ticker XYZ at a price of $45 per share, and they are under that obligation to and through January 21st, the year 2022. This option seller likely has the shares in their accounts. Maybe they're trading at $37, $38, $39, and they are comfortable capitalizing on that move higher in the stock of $6 or $7 and also capturing the option premium in addition to that, selling shares at 45 along the way and giving up any potential should the stock rally sharply into the 50s. I mentioned exercise and assignment a few times, so let's walk through what this looks like, particularly the communication lines and a few key terms along the way. Recapping, option buyers have rights. They have the right to either buy shares of stock or sell shares of stock. It depends on whether or not it's a call or a put option, and this will occur if they exercise the contract. This is generally thought of as a proactive exercise, a communication that starts from the investor, or there is a process known as exercise by exception. The shorthand for that is auto-X. I'll spend time defining that because it is important to understand if an option holder does not communicate any instructions to their brokerage firm at all, the industry has to have a default process by which they handle that situation. What do they do in the event that this investor who holds an option doesn't tell their firm anything? Well, the default process is called exercise by exception, and it involves determining if the option contract has any inherent value when looking at the strike price of the option as compared to the last traded price in the shares during regular trading hours on a national exchange. I'll stress regular trading hours. Based on that analysis, if the option has inherent value of some kind, if the call option trading at 70 or strike price 70, stocks trading 71, the holder has some inherent value there, $1. If that is the case, then auto exercise procedures may then go into effect, and this option might be exercised on the option holder's behalf, whether they've instructed their firm to do that or not. It's a little more complicated on the put side because if there is inherent value in a put option and you've reached expiration and you haven't told your brokerage firm anything, particularly if you don't own the shares, exercising the put means you'll be short stock, and many firms will not allow that. Your account may not allow that. So it's imperative that you understand to get this information from your brokerage firm. What happens if I have a put option that has value at expiration and I don't do anything? Do I get short stock or don't I? You may be in a situation there where the absence of taking action has cost you the opportunity to extract that value if your put option would then be abandoned. The communication line has to make its way from the investor to OCC, that is the Options Clearing Corporation, who handles the exercise and assignment process. The investor communicates to either a clearing member firm of OCC or their brokerage firm who is in business with a clearing member firm. Either way, the investor's instructions get to a clearing member who in turn notifies OCC. I should also point out, as a follow-up to that discussion on exercise by exception and auto-X, if an investor is familiar with that process and they recognize that their option has expired with value, but for whatever reason, they decide they do not want to exercise their contract, and this is particularly the case sometimes when the strike price and stock price are very close to each other and there might be some after-hours activity. The investor can provide contra-exercise notices, which means they are instructing their firm to not exercise this contract regardless of whether or not there is inherent value. The key point here is that the holder of the option always maintains their rights. Auto exercise by exception by no means is a way to remove or strip an option holder of the rights they paid for. It's just the procedure that takes place if there's no communication whatsoever between the trader and their firm. Sellers are subject to assignment. The option seller has taken on the obligation to either sell or buy shares of stock, depending on whether they've sold a call or put. That's 100 shares at the strike price per option, and they will be executing that transaction if assigned an exercise notice. It's very important to understand how and when your firm is going to notify you that you have been assigned. And then you can be on the lookout to make sure you're comfortable and prepared to manage your position for the next trading day. These situations always have a certain level of uncertainty. As an educator, I would have to say that an option seller can never be 100% certain that they are going to be assigned or that they won't be assigned. You can assign a level of probability to it, but the option holder can do whatever it is they choose to do for whatever reason they wish, regardless if it's in their financial best interest. You certainly can feel very confident and predict whether or not you're going to be assigned, but as the stock price gets closer and closer to your strike price, that level of uncertainty goes higher. Option sellers who cannot tolerate that uncertainty and need to manage their position in a way where they're not surprised come the next opening bell would need to close their contract, execute a buy to close transaction, close the open short position, and then they are no longer subject to assignment. And they have the trading day of expiration date for equity and ETF options. On the expiration date, you can trade that closing transaction during market hours. The communication flow is going to work in the opposite direction. In this case, OCC, remember, has received all of the exercise instructions, and now we have to find who's going to be assigned. And this is a two-step process. First, OCC will execute what's known as a random assignment method that's approved by regulators in the industry and select clearing member firms. OCC doesn't have a direct tie to individual accounts. Instead, it's in business with clearing member firms. So OCC will assign clearing member firms that have open, short, assignable positions. And then from there, whether it's a clearing member firm or another firm that you may have an account with, one way or another, there is a second level of random assignment that is carried out, again, regulator approved, in order to select individual accounts that would then be actually assigned. And that is when the communication would take place between the firm and the investor to let them know you have been assigned. And it's just paramount to emphasize, as I talked about just a minute ago, if you are an investor who sold options, you have an assignable position, the only way to eliminate that obligation is to buy to close your options contract. Otherwise, you're evaluating what's the likelihood of being assigned, and as the stock price gets closer to your strike, you're starting to determine how would you manage this position if you are surprised and you get assigned when you don't expect to, or vice versa. You're expecting assignment and it doesn't happen. In the many years that I've been in the markets, it does happen. And I can tell you, the one comes to mind for me where an option that I had sold was a full 30 cents in the money as of the closing bell on expiration day, and there was some after-hours activity, and I was not assigned. And that was a surprise. And those things can happen. Just be aware of them and understand that can happen. Hopefully that wasn't too much for you. That was a lot of basic information and walking through calls and puts and some core concepts. I'm going to bring in Ken Keating here in a second, but while I do that, I want to leave up our contact information again, optionseducation.org. The investor education team, reach us by email at options@theocc.com. Our YouTube channel has a number of these webinars that we've done in the past. Follow us on social media as well, and just feel free to reach out to us. That's what we're here for. Also, if I hadn't said it already, I can't remember, please take the survey that's attached to this presentation. We look at all of the comments and suggestions that we get on those surveys. Please take that. But before you do that and before you leave, Ken, if you're there, why don't you come on and let us know what types of questions people have been sending in, and we can talk about a few of those.
Hi, Ed. Can you hear me okay?
Yep, sounds good.
Hi. Well, hey, I just want to say thank you for everybody for attending today's presentation. We've been getting a lot of really great questions, some of which I'm going to share with Ed so he can answer them directly. So now that we have a little more left. So many of the questions that we've been receiving all revolve around exercise. So just to start off, can exercise notice be taken back? If I choose to exercise a call option or a put option, can I take that back once I fill out my exercise notice? And I guess the quick, well, I'll let you answer. Sorry.
Well, I was going to actually, I would like your perspective as well. My initial response is to certainly contact your firm, but I would expect that exercise notices would be considered irrevocable. But Ken, I'm not sure what perspective you may have on
that. I would say I agree with that. Typically, when you file that exercise notice, you can't take that. To Ed's point, if you file early and maybe you get a hold of your broker and they can rescind that notice before it gets to OCC, it's possible you could have that taken back. But if that notice goes from your broker to OCC, it cannot be taken back. It'll be final. So just keep that in mind. One thing about exercise notices also to keep in mind, typically OCC for our member firms only require that exercise notices be received by 90 minutes after the New York close. So that's 5:30 p.m. Eastern Standard Time. Many brokerages have a shorter cutoff period, so you'll want to check with your broker as to their individual exercise cutoff period, because I have heard some notable brokers in the industry have cutoff times that are as little as 10 minutes after the New York close. So just one thing you want to check with your broker to verify regarding their exercise process. Another question we received is if I am trading options and it's expiration, what if I don't want to take delivery of stock? What can I do? My options in the money, I guess, what are my options? What are my options, Ed?
If you don't want to take delivery, so certainly if your call option is in the money and it has inherent value, then you would be potentially subject to exercise and getting the stock. And this is what you don't want to do. You don't want to take delivery. You have a couple of choices here. The best choice of action is to make sure you execute a sell to close, get rid of that position and sell it for what it's worth. prior to the closing bell on expiration day. If you don't do that, then you have missed your opportunity to capture value out of the option, and your only choice then would be to exercise and get shares. If you're not in a position to do that, then you would then have to abandon your option or offer that contra exercise to abandon an option that has value. That would be an unpleasant circumstance. And then the other options trade that would be subject to taking delivery of shares, sold puts. If you sold puts that are, again, in the money, and you would be expecting assignment subjecting you to purchase shares of stock, you have to take some kind of action to remove that obligation, and that would involve buying to close the option that you sold, perhaps at a loss, maybe not, but perhaps at a loss, buying to close and getting rid of that open short assignable position prior to the closing bell on expiration day. If you can make that transaction and execute that transaction, then you will not be assigned. Exercise and assignment activity takes place after market hours, after the closing bell. If you open the trading day with a short position and you close it, then your obligation has been eliminated.
Sounds good. Sounds good. Another question we received regarding how many options get exercised prior to expiration. I know that OCC, for years we generate statistics, exercise and closing stat statistics. And generally speaking, it always falls around between 6 and 7% of options are actually exercised. Now, if somebody exercises an option early, no Ed addresses in the presentation, keep in mind there has to be an economic incentive to exercise an option early. And why is it? Well, that's because when you exercise your option early, you're going to forego any time premium left in that option. So why would somebody do that early? Why would I exercise and forego my time premium? Well, maybe I have a stock that's going ex-dividend tomorrow, the day before expiration, and the dividend for $1. And the extrinsic value in my call is maybe 10 cents, okay? It has all intrinsic value and there's very little time premium. That call is going to be a strong candidate to be exercised early if I'm short it for that $1 dividend. So it's just something to keep in mind that especially if you're doing covered calls on stocks that pay big dividends, something to keep in mind around the ex-dividend date. Generally puts will typically get exercised early if the short interest that you might receive on a long put is greater than the time premium left in that option. These days, with interest rates being practically zero, that doesn't happen as often. But that's the only way somebody would typically exercise put early. But once again, most options are carried to expiration, because of their time value, and at expiration, roughly about 6 to 7% options are ever actually exercised. Very small percent. About 72% of options are closed out. They're either bought back or sold before expiration, and about 21% of options end up just expiring worthless. So just a few statistics for you. Let me see. Another question here. Why is it when I see an option price, why am I paying 100 times the price of the option? If the option's trading for $1, I'm paying $100 for that. Ed, I could throw it your way.
Yeah, we did discuss that a little bit in that the option is quoted on a per share basis, and when you consider the premium of the contract, what you'll see there is, in the case we're seeing, I'm showing that $2.50 was the option premium. That is quoted per share. Options, a standard option contract is written on 100 shares. The buyer has the right to buy or sell 100 shares. The seller has the obligation to either buy or sell 100 shares. So that per share number needs to then get multiplied by the number of shares that underlie the contract, in this case 100, and there you have $2.50 being multiplied by 100 to come out to $250 total dollars. And that's the quick math that you're always going to be doing for standard options, is looking at the premium amount, multiplying it by 100, and that gives you your total dollar cost if you're buying, or total dollars received if you're selling.
Perfect. All right, I think that pretty much wraps up our presentation. I know that there's a couple questions we didn't get to. I will let you know that all your questions will be answered. Somebody from our investor services team will certainly reach out to you with an answer to the questions that weren't answered today. And we do appreciate all the questions that came in today and for your participation as well. So Ed, I'll go back to you and again for the presentation.
Yeah, thanks, Ken. Those are good questions. I can see a lot more came through. I really appreciate everyone's participation today. And again, a reminder, please take the survey. We do take all of those answers and input in our decision-making process moving forward for the future of our curriculum. So thanks again for joining us here today, and we look forward to seeing you next month for our next presentation, which will be presented by Mark Benziquin of the OIC team. Look forward to seeing you then. Have a good night, and good luck trading.